These will all be posted on our YouTube website. Yes, we have a YouTube channel for the Drake Risk and Opportunity Forum. So all past years and this year's sessions will all be available there. I'd first like also to thank our steering group. And if you're a member of the steering group, could you raise your hand just to let people know who you are? Thank you, thank you. This group, we start in January looking at topics that are timely, things that are relevant and important to the industry and to practitioners. And so we bring all those ideas together, and it's the program that we have here for today. So thank you very much. With that, we'll get our first panel underway. Have a great day.
Thank you, Kevin. My name is Rebecca Young. I'm the Chief Risk and Audit Officer at F&G here in Des Moines. So it's nice to see all of you today. Just a little bit about me first. I'll be the moderator for today, so I won't be in the hot seat. I get to put these two and hopefully one other person virtually in the hot seat as well. But I've lived in Des Moines most of my career. I've been part of Ernst & Young as an external auditor. I've been a controller. I worked at Wells Fargo in the audit department, and I landed myself at F&G a couple of years ago as their audit executive, and I recently took on the Chief Risk Officer role as well. If you happen to be looking at the bios, you'll also see that I have a passion for serving not-for-profits in the Des Moines area, and one of those is the Des Moines Symphony. So the little-known fact about me is that I started as a music major, and here I sit today as a risk officer instead. So it's kind of fun to see where people started and where people end up, and I think that our panelists are going to tell you a little bit about themselves in that same way as well. So today I have with me Mary Thielen. She is from USAA, and she is the VP of Enterprise Risk, PC, and Financial Risk as well at USAA. And then we also have here Bram Kruger. He is from Reinsurance Group of America. He is the Vice President and Chief Risk Officer for the U.S. Individual Life business at RGA as well. And we do have a third panelist who may be joining. If he does join, we'll introduce him at that time. For now, before they introduce themselves further, I would like to start, since we are the first panel, with a little bit of audience participation. I'm sure you've had your coffee, hopefully, so pay attention here a little bit. It won't be too hard. First, it's really exciting that this is here at Drake. So are there any students in the audience at 9 o'clock in the morning? Yes. Okay, we have a couple. Thank you for joining. I hope that you find this to be interesting and beneficial. And think about that statement I made of, I started as a music major and now I'm a risk officer. So you guys are on the journey, and who knows where you will end up with your careers later on. How many people are here who work in insurance? Quite a few. Non-insurance? Couple. Okay, perfect. I know we have a non-insurance CRO panel later today too, so maybe some of those people will be coming yet today. How many IT professionals in the room? Couple. Perfect. How many accountants in the room? How many actuaries in the room? All right. Perfect. Well, that's enough audience participation. That's helpful for us. That's helpful for the other panel members who are out here who are going to go later today, so thanks for taking part in that. So I'll first turn it over to Mary to tell you a little bit more about herself and how she became to be where she is today.
Thank you, Rebecca. So Mary Thielen, I am an Iowa native. So you hear USA, you're probably thinking Texas. But I'm an Iowa native. I grew up in Iowa, and I went to University of Northern Iowa, so go Panthers. Yeah, there's at least a couple of us here. So awesome. And I'm an actuary by trade. I raised my hand for that question. And my story is not as interesting as Rebecca's. So there's no music major in my history. I was an actuarial science and statistics major at UNI. That is like a really small program, so actuaries at Drake are probably like, UNI has an actuarial program? They do. And it's got a good history, and the professors over it are still the same professors, so I was actually visiting with them earlier in the week, which is awesome. So my career, is really kind of boring. I loved math, statistics, knew I wanted to do something, liked the practical side of it, didn't want to do theoretical math where I was trying to prove something that was really complex. I wanted what can we action on this? So basically found out about the actuarial path through my family, followed that. First 10 years of my career were real traditional actuarial pricing, leadership, and such. Really stumbled into risk management, to be honest. I was doing the actuarial work, loved its interconnections with the rest of the business and wanted to just kind of continue to figure out, like, how do we integrate in the business more, where, how do I bridge that gap between actuaries and others. And so I had moved to product management at one point, and then American Family went through some transitions in leadership in around 2010. And at that point, I was asked to take a role that was VP of loss reserving, which doesn't sound like risk management, but it was loss reserving, capital modeling, and ceded reinsurance were the three functions that were under that role. And we didn't have ERM like American Family did. I still call them we. I was there 24 years. And so it's 2010, it's post-2008 crisis. It wasn't a lot of there was no real ERM requirements, ORSA didn't exist at that time, things like that. But if you know anything about American Family's history, they started acquiring companies in 2012. And so quickly needed to build something up that was a little different. And so that VP of loss reserving job in 2010 turned into the CRO role and kind of built it from scratch. So I have a really unique perspective of being in a company that needed to build ERM from the base without a lot of regulatory or stockholder or their mutual company requirements. So really building what's best for that organization at that time based on their activities. So anyway, I was there for 24 years, did a lot of things after the CRO role. I led their largest lines of business on the personal line side and did a few finance, controller, different things as well. About 2 years ago, a little over 2 years ago, I said, I either stay forever or I try something new. And so I did try something new, and I went to USA, much bigger company, about 3 times the size of American Family. So it is an interesting transition to see that. And I'm still on the P&C insurance side, and I have basically all the financial and insurance risk, strategic risk, pretty much the side of P&C risk that's not compliance, operational. So really kind of a little bit back to the actuarial roots, but also still have investments and things like that in there. So really love that job because that probably fits my skill set the best. But I've done a lot of different things over the course of my career.
Thank you, Mary. Good morning. Bram Kruger, as Rebecca noted, Chief Risk Officer for U.S. Individual Life for Reinsurance Group of America out of St. Louis, Missouri. I only joined the risk role, or the risk world, at the beginning of last year. My career was really very generalist and very much on the business side of things. I had the privilege of, I think, working in all lines of business that you can on the direct insurance side, from group benefits to individual life, pension risk transfer, guaranteed investments, institutional investments. So really a breadth of product lines that I've been able to work in, and then also a breadth of types of roles that I've played, from product strategy and product development to operations management and more general management across various lines of business. And then add to that, so the accent is South African, if you were wondering. I also had the privilege of working across various markets. So a lot of time in South Africa. I spent a number of years in my career traveling across East, West, and North Africa, helping businesses there with their product strategy and product development processes. And then most recently, before moving to the States, I was in Canada, again, driving transformation and product development and product strategy for the company that I worked for there. The most recent role that I had actually was in business development. So that is sales. And a lot of people ask me, how do you go from sales into risk, which is kind of a 180 in terms of career focus and perspective and what you bring. And for me, it was really a conscious decision. As I was thinking about building my own career, there's probably 2 areas where you get to see everything. One is finance. I'm not an accountant, and that kind of rhythm of reporting wouldn't work for me. I'm much more, it's just I need change constantly. The other option was risk, because with risk, again, I get to see and interact with everybody, from the underwriting at the front end all the way through to where the claims are paid and everything in between, valuation, finance, the pricing and product development teams. So I get the opportunity to interact with all of those teams, and it really has helped me build out my capabilities. I also think the reason I was put into this role was the breadth of experience. because it brings credibility. You can understand the business. A lot of the times, risk management can be seen as a compliance gatekeeper. It is a checkbox, whereas I see it much more as a strategic advisor to the business, helping them make good decisions. Probably the biggest challenge for me having moved into risk management was I can only do through influence. I don't get to do any of the parts myself. I need to build the relationships with the various leaders in the business, make sure that they own the risk and they do the right things for the company. My mother, they had visited from South Africa over the summer, and she wanted me to explain to her, what do I do? What's a chief risk officer? I really struggled to kind of put it in layman's terms. She was a 5th grade English teacher, so not in the financial services world. And the best way in which I could describe it was, I ask questions. My job is to ask good questions. It's to listen to people, ask questions. Have you thought about this? But what if that happens? Okay, if that happens, what would you do? And that is part of why I just love this job, is I could just ask questions and listen.
All right, thank you very much for giving that introduction, and hopefully some of you students took away from that. That's part of why we did that. We wanted to share where we came from and where we are, and just keep your mind open all the time as you're going through your career for those next opportunities. When it comes to being a risk officer, much of what we do is driven by the level of risk our companies are willing to take on. Tell me how you have seen risk appetite evolve in the insurance industry, and why do you believe that change is occurring? And we'll start with Mary.
I think one of the evolutions I've seen in like risk appetite across the insurance industry, especially on the P&C side, has been I'll call it the level of detail, and there's a couple of ways I'll talk about that. One is, when companies were usually starting their risk management programs or early on in that, they were and are very solvency focused or very worst case scenario focused. So kind of extreme tail events. What does that, what's our risk appetite for that? And then different companies moved at different paces, I would say, like stock companies, which I have not been at. I've been at a mutual company and now at a reciprocal. Moved faster into earnings volatility, but I think every company is likely moving into like more earnings volatility risk management appetites as well. That doesn't negate the solvency and the pure kind of tail event aspect of it, but it's an addition. So that's when I talk about details, I talk about I think risk management appetites have been evolving, meaning adding more and more. It's not that anything's replacing or completely changing. It's adding to it. So that's one of the things I see. The other one I would touch on is at what level, right? And so risk appetites, I think, started out as the overall, as it sounds, enterprise risk, highest level risk appetite. At what point would the board take action, or is there something of that nature happening that's extreme? And those still exist, and those should still exist, but I see more and more sub-levels of risk appetites, and sometimes they're called different things, triggers or lower components, where they're action levels for different levels of management, right? And so you might still have your board risk appetite, which is your overarching enterprise risk appetite, but you might have a level that's more one level lower, that at that point senior leaders need to be talking and taking action, figuring out how to fix it. As you move down, there might even be sub-unit risk appetites of, if my unit, I run, in this scenario, a sub-unit of an organization, and if that is beyond a trigger, it's a risk appetite just for that unit. So I think that's what I'm seeing, is a lot of detail being added around the depth and breadth of the risk appetites. And the interesting challenge that comes out of that is, how do they all fit together, right? How do you have them kind of cascade in sequence and not have something at a higher level triggering that's not triggering at lower levels, and that's easy if they're just, the same measure at different thresholds, but often it doesn't make sense for them to be the same measure at different thresholds, and so they're more complex and nuanced, and so figuring out how they fit together as a risk management program, I think, is one of the challenges that comes out of that as companies work through that.
Mary, how do you go about setting those different levels and integrating them together?
Yeah, I think it depends on the maturity of the organization, has been my experience, but usually there's some sort of history. So even, and I won't go into too many details, but even at American Family, prior to having risk management, they had a capital model, and so they still had kind of a risk appetite in terms of how they ran that model. So there's some sort of history typically. Obviously, if it's a startup, you'd be building from scratch. But then you start to ask, I liked the ask questions, like what would you be okay with? What would make you nervous? When would you feel like you needed to act? When would you want to know about something, even if you wouldn't act yet? And having those questions. I think at the end of the day, most organizations for enterprise, for the top level risk appetite, it's the board's decision, and the board needs to approve the risk appetite they're willing to take for the organization. But they don't do that in a vacuum. They need to be fed information and probabilities and information around possible risk appetites for that discussion. And I think one of the things I learned most was like, if you're going to make changes to risk appetite, how do you reflect the history and strategically change over time to where you want to head and respecting that history?
Thank you. Bram, what are your thoughts?
Kind of what I've observed over the 18 months that I've been in this role, but also through my time in the industry, is the conversations around risk appetites is shifting, not away, but in addition to being a really technical exercise where it was mostly focused on the insurance and the financial risks. So it was a conversation with the actuaries. That's kind of where risk lived. And the focus is shifting with the world becoming more complex, and the interconnectedness of things is around operational risks, things around cyber and reputational risks related to third parties. And that's changing the conversation around risk appetites to be a company-wide discussion. And that's not easy, because it's easy when you talk about risk appetites to set it where you've got stochastic simulations, you've got histories of data, and you can set thresholds for financials. What is the impact of a reputational risk event happening? What is the cost of that? And what is the threshold that you're happy with? Kind of my colleague on the operational resilience side, he always calls it the cry or die thing. And it's very difficult. It's very subjective in its approach. So as a risk management function, we need to get more comfortable with balancing both the quantitative balance sheet side of risk management as well as the more qualitative judgment sides that's applied to the operational risk elements. The other big change that I've seen is moving away from risk limits just being something that is decided and put on the shelf, but having a lot more detail in terms of so what? If you breach this limit, so what? What do you do with it? So it becomes much more of a strategic tool in business decision making as you look at different business strategies, different product lines, bring the risk appetite in the conversation and measure it against that element. What's driving this change? I think there's kind of three forces at play. The one is just the complexity of the risk. The nature, AWS earlier this week taught us a lesson of just how interconnected different things are. So the operational element is much more complex, much more impacted than we had seen in the past. The expectations from regulators are changing as well across the various states and also various countries, looking for more documented processes and controls around how you manage risk. So that is forcing a lot more conversations around these operational risk elements. And Justin, this is specifically from an RGA perspective, but I'm sure it applies to other companies. Boards and executives are asking for it more. They want to have better oversight and line of sight into the operational risk elements. So I really think that risk appetite is becoming much more holistic, practical, and embedded in the way in which we make decisions.
You talked earlier about influence. Is this one of those areas where you have to influence the lower lines of the business to convince them why these thresholds and limits are necessary? Any thoughts around that?
Yeah, I definitely see that. And I think as you work through that influence, one of the most difficult challenges that comes up frequently is the so what, like what would I do if this triggered, as well as because of the complexity of business, it could trigger for 5 different reasons, or more, infinite number of reasons, most likely. And so for folks that look at it very black and white, I'll say, and want that well, if it triggers, I'll do this. There's not always that answer. So sometimes I get a lot of discussion and need to influence past the mindset of like, well, I don't want to have something that could trigger that maybe I wouldn't do anything about. Like they can invent a scenario in their head, and those are not just invented; they can actually happen. They're legitimate concerns, but and usually that's not for like the top board level risk appetite. It's more like for like the management action levels or triggers. Before that is where I've typically seen it, where you might say, oh, it did trigger, but here's why X, Y, and Z, and I actually don't want to do anything yet. But you still feel better knowing it, monitoring it, and maybe it's because you think it'll self-resolve within a period of time that's acceptable. It's due to a unique circumstance that's outside of the company's direct influence. You might already have actions in place that were addressing it before it ever triggered, just as part of business processes. But that's the largest area I see a lot of influence needed is like working with business partners to get to the right comfort level. Because it's not just, we'll have a metric, it'll trigger, no big deal. Like you don't want that nonchalance or attitude towards it either. So it's like finding the right balance of like, well, what's an okay measure that may not, like they're not going to be perfect, that we can get comfortable with, and then finding the right level within the framework to put that. So as I talk about risk appetite at the highest level, that's usually like your risk, like a lot of times that's just literally called your risk appetite. Below that, you might have risk indicators or key risk indicators or risk measures. Every company I'm sure has a different terminology for the levels of risk pieces that come into the appetite framework. But like finding the right level for it then, right? If it's something that you actually might not do anything about it, it's probably not your top level risk metric. It's a subsidiary metric at that point. And like what's the right level and what's the right, based on that, where does it get reported to? Is it just being reported to local management? Is it being reported to senior management? Would the board ever see it? Those type of considerations. But that influence to get people past that hurdle of, but there is a scenario that could happen where I wouldn't action, and I don't want to trigger and have to explain to somebody that I'm in the, that I have a yellow risk measure. Getting people past that when appropriate and finding the right, I'd say, compromise or a right approach is a really important part of the influence that I've seen.
Yeah, I think that scenario planning and that conversations with the business around what would you do is so important in getting that buy-in and getting that influence. And using past experiences, again, I'll touch on the AWS outage. Use that as an example. Actually talk through that and get the buy-in from there. So there's that influence piece to make the business understand that it's important. But the other part of it is also just, it is a big mind shift. And I'm speaking specifically around the operational risk elements. It's a big mind shift change. And to be able to actually measure and track these things from our perspective, we need to change the way in which we think about risk. At the moment, it's very much built around process. So you might have an underwriting process and what's operational risk around that. But if you want to actually start measuring and building metrics around it, you actually need to start with what causes a risk event to happen. And building up from the cause to the event to the impact and building your risk framework around that. And that is a fundamental mind shift that you need to make within the business, and you can only really achieve that by influencing and explaining why this is important.
I think that causes a good segue to our next question, which is around emerging risks. This is an area that we all have to pay attention to, but it can be difficult. And it can be difficult to understand when something is really no longer emerged and it's here and you're kind of flipped over, to your business as usual process. What are the key components of a strong emerging risk identification program? And if you have any really good examples of a time when you were successful identifying something early, that would be great for everybody to hear as well. And I'll start with you, Bram.
Yeah, so I'll give you the approach that we take within my business unit from an emerging risk perspective. We start with an annual process, so a survey across all of our global teams, and not just at an executive leadership perspective, but really at that first-line management level, really unearthing all of these potentially emerging risks that they can see on the horizon. We augment that with information that we get from the industry, conversations in forums like these, as well as surveys that the SOA and others do, and we build a fulsome repository of potential emerging risks. We then rank those. We then think about what is the time horizon for which they could emerge over, what is the velocity at which this is happening at, and what the impact to the business would be. Once we've identified those, we take that back to the business, and we assign clear ownership, not within the risk team to track it, but within the business teams to actually own these emerging risks. And depending on the risk and the velocity and the pace of change of that risk, you might have much more frequent interactions around that risk. What has changed? What will we do? What are those low-cost things that we can do today that would mitigate the impact of that risk when it's actually emerged? And then we continuously, regularly identify those. I don't have a good example of where we avoided a risk, but something that is very topical for us at the moment that we continue, as a global company, continue to manage, and something that we identified as just geopolitical instability across the globe. We've got businesses in various countries, in various regions, so we've got a cross-functional team of really subject matter experts that we engage with regularly, and we decide on what are the action plans. Do we engage with federal, at a federal level, at a state level, within different countries? What are those action plans we need to put in place? It could be simple things such as, we've got a team in Dubai. What does it mean in terms of if we needed to extract them? So really holistically thinking about that risk on a proactive and ongoing basis.
Mary?
Thank you. So similar, I think you talked about this annual survey and kind of getting information from not just the executive team, but I think a good emerging risk process has both a top-down component of like what is the board and senior management worried about and what are they seeing, but also a bottom-up, so kind of coming at it from both directions. I think that gives a more wholesome view than just one or the other, or cascading in one direction or the other. And so I found, almost running two independent processes, one top down, one bottom up, and then seeing what is similar, different, what are the blind spots, if you will, from the different angles, is a really important component. The other thing that I, early on in my risk management career, didn't probably give enough weight to was headlines, and especially headlines outside of the insurance industry, right? So. And I think there's a component of this that is true risk for the insurance industry and an insurance company, and some of it that's what the board members are seeing other places. So how do you answer the mail or answer the call? So there's a different component on both angles, because sometimes they are true risks that just aren't hitting the insurance trade press, that are more just general business headlines or general headlines in specific. So those are kind of two like supplementary things that I think come into a really good process. The other thing that came to mind as we're talking is, I think when you asked the question, Rebecca, you said what's truly emerging versus what's emerged. So having a robust enough program to not only have that definition, but then how do you handle things that have emerged but are still new and you still don't know everything about them? Or a long-term risk that's evolving. So, I think of about as like emerging risk, evolving risk, new risk, things like that. Like how do you have a robust enough program to handle them? Because just because it's maybe not emerging, it's evolving, doesn't mean it doesn't need special attention relative to other more stable risks and risk appetites. So that's another component that came to mind as based on how you asked the question, which I think was good. In terms of success, I don't think these are necessarily avoiding risks, but I think a tactic I've used, and it's funny because we're kind of sitting with both of them, so that's probably why they came to mind. But it's not like this is just in the last 6 months. So this is something I've seen done over the course of the last decade or more in risk management that I think has really helped the organizations, is just getting ahead of some risks. So we're in the middle of lots of different tariffs, government shutdown. Those impact companies, those impact different companies in different ways, right? So having sat at American Family and having sat at USA is much more closely tied to government employees, military, right? Make this not secret sauce here. That's our whole mission. And so those have different impacts across different companies. And so, did we prevent the risk? No. But what I have been really proud of and seen work well at multiple organizations is like when there are those, and I'll generalize it into those macroeconomic headlines. Those are the two that are really relevant right now. But like those macroeconomic headlines that are out there and are potentially coming, right? You're seeing them come. They're not within the control of the company. But getting ahead of that, months ahead of that, doing analysis around like what is the impact, what is the range of impacts you could see. So doing that, when the first political talks of tariffs are happening, rather than when there's executive orders on them, as an example, like doing range, and you don't have any answers, right? Like I love it because then everybody likes to pick apart the math, right? Well, why did you assume that tariff in China? Like I haven't heard that one, and so like you usually have to have some rationale for why you pick what you did, right? Because you have to defend it. But getting that range and those worst case scenarios out, so it's not just the fear of the headlines, and especially if you're in a company that is cross industry or cross segments, so it affects life companies different than P&C companies. And so if you have life leaders in the, executive leadership team, they might be thinking one thing that's not actually true about P&C insurance. Or you have P&C leaders who have grown up more on the marketing sales side. They don't know as well how much these things would impact the financial side. So kind of, I guess, myth dispelling with like actual scenarios and financial planning ahead of some of those emerging risks has been a really helpful technique for me, because then if we do it broad enough, like one of the things that I've seen happen was like, how do we react every 6 hours to the news cycle? Well, no, let's put that to bed. Let's do a robust enough analysis that's like, you can't completely ignore it, but a robust enough analysis that like, here's a very mild scenario, here's a medium, here's a high scenario, so that when the news changes in 4 hours, when something's taken back or put on, you just move between scenarios. You don't have to recalculate based on the exact numbers. So as long as your breadth is significant enough that it captures it, and I'm not going to say we've always captured that breadth, but as long as that breadth is like, okay, well, we're probably at the middle scenario. Okay, we're probably 25% worse than the middle scenario. Like you can get to that type of thing where you're then not sending teams down spirals and spending, and for us, it's policyholder money, member money, doing analysis that you could do once more broadly and then not get into a spiral that is not healthy for, cost management. It's not healthy for your employees as a leader. It's just not, it doesn't add a lot of value, but it's still responsive to the environment. So that's probably where I've seen a lot of success of just trying to get ahead.
I like that. And what I heard you say is that we are mythbusters. So, okay.
I think in terms of the emerging risks, maybe that's for the CISO panel that's coming later today, is the one that I personally, and I think as an organization, we really struggle with is, has it emerged, is it still emerging, is cybersecurity. It's emerged, it's here today, but it's also changing very quickly. So it's emerging in terms of new technologies and AI, and striking that right balance between addressing the problem that's at hand versus what do you do to be future fit. And that's really, it's a difficult tightrope that we still struggle to balance.
All right, let's talk about the risks that are here today. So we'll move on from emerging risks. And there's plenty of industry data out there around top, risks that we all should be looking at. But in your opinion, what are key risk areas you believe the insurance industry and our ERM teams along with them should be focused on monitoring? So pick your hot topic.
I think honestly for me, the thing that is the most uncertain and getting more and more complicated by the day in managing from a risk perspective is regulatory and compliance risks. It is pretty disjointed across various states within the US and then at a federal level, and you've got, and for us working as a global company, there's also global regulations, things coming out of the EU, things in Canada, around data and privacy and AI and market conduct. And it's just changing so quickly, and it can change 180 degrees from one version to the next version. So how do you make sure that you remain on top of it? And also, how do you make sure that you gather all of these compliance things that are changing and making sure that you actually stay focused on it? And for us, and at least for my team, it is compliance and market conduct is a part of all the conversation with all of the various risk owners. It is a standing topic on agendas that I have with the business leaders, is understanding how are you staying abreast of these things. Where I understand and good contact with my legal colleagues as well, bringing that into the conversation. I think what is making it even more tricky in terms of a risk management perspective is these things also impact third parties and other providers that you work with. So how do you manage the risk when you don't control the risk management practices at those third parties? So things like good due diligence when you engage in your third party is so important, making sure that your technology partners and your compliance partners are part of that due diligence. And then regularly going back and making sure you rank and you look at what the risk of this specific endeavor might be, how frequently, how regularly do you need to go back and test that again to make sure that they also manage the risk on your behalf. So for me, it is really making sure that it's front and center of the minds of the business leaders as well as the people on the floor.
Mary.
Yeah, I'll give a PNC pretty specific example, and then I'll generalize it as well. But I think a really important risk, and it's not new, but it is changing, is like catastrophe risk. And you can take that into climate change and climate impacts, but just catastrophe risk in general. Like, what are the potential weather and non-weather events that will impact your book of business, and how are those changing over time, right? Significant wildfires in January in California that were, the top 2 wildfires happening at the same time in the United States. That's pretty significant. I think most companies that write homeowners business in the Midwest or anywhere that's subject to severe convective storms have probably been struggling with severe convective storm modeling and estimation for the last 10 years, if not longer. That is not a unique problem to the organizations I have been at. So I think that is a top risk that, that's the nature of the business. That's why we're here. We're here to pay claims. We're here to, fix people's houses, fix people's homes, but yet it is a major risk. And there's all sorts of, you mentioned earlier about how like at risk you get to see everything. It affects the whole value chain, from pricing to underwriting, to servicing, to the actual claims handling, to reinsurance, ceded, if you want to diversify, assuming reinsurance, like it really affects the whole spectrum. So I think that's important. That can't be overlooked. And sometimes people say like, oh, should we really be worried about climate change? Like, yes, I would say, personal opinion, yes. But regardless, like catastrophe risk is a major component, and it's a driving some of the regulatory risk and availability and affordability for customers and of insurance and things. So it's intertwined with all of that work. And I'll take to make it more broad, I'll take the concept of like, often when you're in the catastrophe risk space, you think about concentration risk, like how much do we have insured within a geographic footprint, whether that be zip code, county, census block, grid space, anything like that. But what I have found is risk management, the other risk that we can help with and need to really be diligent about is concentration risk well beyond catastrophe risk. So where are we concentrated that we don't even know we're concentrated? Then that can be with your third parties. That can be with how much are you relying on AWS East region? Are we concentrated at a certain cloud provider? Do we have real estate investments that are correlated with our catastrophe risk that's written on the books? It can be, all sorts of different things, but often the risk management department is the only department that is sometimes looking across those things. A big part of my job is, since I have the investment risk as well as the insurance risk, is like connecting those two. Like, how are they connected, correlated? How does inflation affect both? How do storms affect both? How do tariffs affect both? All of that thing. And the people in the investment division, and it's no fault of their own, they're investment experts, and they are doing their best to, earn return on the company's money on behalf of the owners, and that's what they're worried about. But if they have a blind spot to not knowing what's going on in the business, and the business, often in P&C companies, pretty common, the business and the investments are fairly separated. It's a little bit different than life insurance, where there's a lot more ALM matching and things like that, just because of the short-term nature of P&C liability. So a lot of times they're fairly disconnected, and so then the business area is just worried about their area. So often it's the risk managers who can see things across that are concentrated or correlated and say, wait a minute, somebody should be thinking about this. It's not always a solvency type risk, it can be, but it can just be a how do you optimize performance, or how do you maybe not optimize in your silos, but create something that's better overall. And it's interesting because I'll share a little staff member story, because I think he's a fairly experienced person, 5-10 years in the industry. And he said to me one day, well, how can they not care? How can investments not care about this that's happening in the business, or the business not care about it? And it's because that's not their job. They're doing their job. We just need to bring this to them and then try to influence, back to that influence action that's better for the organization as a whole, rather than allow them to just stay where they are. But I think that's a really important key risk that we need to pay attention to.
Thank you. So now we're back to the audience participation part of the panel. Do any of you have questions? Wonderful. We have a mic for you coming.
So when you analyze risk, do you also look at it through the lens of good risk and bad risk? Is all risk the same, is what I'm asking. We talked about risk a lot, but in our own lives, we take reasonable risk, but also is there a good risk or bad risk?
Absolutely. So an insurance company wouldn't operate if you didn't take risk, right? That's just the nature of what the company is. And so I think things that are good risk or bad risk, one, are you getting the proper return for that risk? Is it priced correctly? Is it, getting an appropriate return? And then is it within your overall appetite? Those two things to me mean it's a good risk. If you're getting a return and you can manage it, then it's a good risk. But absolutely, I think there's a good and bad risk component.
Yeah, I agree. We're in the business of taking risk. It's making sure you get rewarded for it. And there are risks that you just don't want to take. And it's being clear and upfront about that, and making sure you've got the frameworks in place to avoid those.
Well, first of all, thank you. I have much deeper appreciation for your roles with all the background you gave. My question is, you talked about AWS outage really briefly. There was the Microsoft CrowdStrike outage in the last 8-10 months. So have we learned any lessons? Because in tech, it's just getting started, the way I see this coming from the tech industry, with the AI adoption, the cybersecurity. So has there been any new ways to manage this risk, or at least forecast for this risk and being resilient about those risks?
I think from my perspective, these events are very telling as we look at our own business resilience and business continuity planning. Something that we struggle with at the moment is everything is important. And then you get an outage like this, and the company didn't go down. We could tolerate a day or 2 or 3 without that service being in place. So it's really enabling us to be crisper on what those critical things are. It's enabling the conversation around what are the things that just make you cry versus what makes you die, and what's the cost of bridging those. It's enabling that conversation with the business around, well, this can be 24 hours, but that's expensive. What can you tolerate? So I think it is through these events that are happening, it is enabling richer conversations and looking at real-world examples through it. I think what it is telling from a risk management perspective, and I think I touched on it a little bit earlier, is it is from our perspective at least showing the vulnerabilities into third parties and how important managing the third parties, because we might not have a risk, but the fourth or fifth kind of downstream might have, and that impacts and falls down within your thing. So thinking through the value chain, what are those critical components? What are the workarounds that you can have around it? Yeah,
I would echo. I think the two lessons that I'm hearing talked about a lot are How does it influence risk appetite? So I like your cry or die. I might have to figure out how to work that in. But like, what is risk appetite? It's very different if, if you think about like this week with AWS in particular, so much was out. It was just a relatively short period of time, but so much was out and everybody woke up to news that there were major outages. And so how much patience did a customer have that morning if they couldn't do something? Especially, if they needed, USA has a bank, if they needed money, cash out of the debit card to be able to buy gas for their car to get to work or something, less patience, right? But if they, needed to change a deductible, probably more patience, because it was a worldwide outage, just as an example. So I think risk appetite around what is unique to your organization versus not. So, and like what is okay to be down and what is not okay to be down. So like advancing those. I can remember conversations years ago where it was like, everybody thought their thing was really critical and everything, and you get to this point where like everything has to be up at 24/7, no downtime ever. That's not practical. Like you will not be able to fund that. So what is practical? What is really, truly critical that you can do? The other thing I think it's eliciting some conversation around, and you mentioned third parties, and that's one component, but the details in the business continuity plan. It's easy for folks to take a, oh yeah, we'll just fail over answer and like, but have you actually tested that fully? If you've got a third party that can't, does that break the whole chain? If you've got a process that's dependent on 10 systems, if one system or one component in that chain of 10 can't fail over, you have a problem. And so I think the detail that I see being asked and hear from peers being asked in companies around that is more specific than maybe it used to be. And so I'm assuming companies are learning lessons and that's why they're asking those questions.
All right. Well, thank you very much for asking those questions and listening to our panel today. Join me in thanking Marion Brom for being part of our panel today. Thank you.
Thank you very much.